Okay, um, now let's talk of impact of economic fluctuations, how economic cycles affect us all. You see, usually economies, uh, the economy or its performance usually follows a boom and bust pattern. Okay, a boom and bust pattern. Okay, this one is what is called the boom, and then this one is the recession or the bust stage. All right, and this part is normally called, because we are going up, is the recovery. We are recovering uh, from the recession. Then when we reach the top, we are at the boom. Then we start again to fall. That's what normally happens in an economy. It's not always going to be a field of roses. Sometimes you face difficulties. Of course, if the difficulties persist for a longer time, then there could be some problems which the government has to, I mean, has to remediate or to address. Right? So much of that on another forum. Right. So under the boom, like I said in the introductory part of this lecture, we talked of our, I mean, our responsibility in this paper as students. When we are looking at macroeconomics, we are looking at its impact on three things. All right, the individual people or persons, individual persons, the households, their families, the family setup, as well as the the businesses around us, right? So if there is an economic boom, when things are good, everything is fine, right? You get a job when you want it, you get a good when you want it, when you feel like you want to drink Orange Crush Mazoe, you get them in the shops. When you feel like you need a donut from OK Zimbabwe, you are going to get there and buy your donut. You find it there fresh and so forth. Everything is fine. That's a boom environment. When you want data, you don't have to worry about Starlink or Econet or Net1. You're going to find everything. When you need, to do your digital money transfers, all right. When you approach the M-Pesa, when you approach the Econet, the EcoCash, the One Wallet, everything are going to be functional. They'll be having all the float you need, or all the money you want to withdraw. Then we can safely say that we are in a boom environment. So, in a boom environment, individuals will be having higher incomes. They are well paid. All right. There is an increase in employment. All right. The living standards themselves are going to be very, very high. All right. The wellness index or the happiness index is also going to be high. So in that context, everybody is happy, right? What about to the households? Yes, the households will be having increased disposable incomes, right? Their pockets will be very, very, wet. They'll be, fat pockets, all right? Higher asset values, the homes will be expensive as well. They will be regaining their value, all right? That's for households. And then the businesses, whatever they are selling, there will be higher demand for those things, all right? And they will be making a lot of profits as well. There will be a lot of investment opportunities. That's when you will see companies, I mean, expanding. You'll be shocked to find a Chicken Inn Plaza or a Chicken Mart Plaza in Murambinda there. Right? That will be investment expansion. That's expansion of those businesses, right? In a rural village in the midst of the forest, you'll be finding okay Zimbabwe there. Why? Because that's the boom environment. Every place, whatever you need, you'll find it there. There won't be any differentiation between growth point and uh, this Poroto Brook or Mount Pleasant, whatever these shopping centers in Harare. There won't be that differentiation. Everything will be just the same. All right, that's the boom environment. All right, whatever you can buy in the central Harare business district, you are going to find it in Chirete, Tovani, or in Blawayo, in Muzilikasi. You're going to find everything there. That's the boom environment. Now let's look at the recession environment. In a recession, individuals, they will lose their jobs. They will be paid, closer to nothing. You'll be donating your hours, your labor. You'll be donating free of charge. And your spending power will be so much reduced. The households, they won't save anything. Families will be struggling. Potential debt increases. Falling asset values. Those homes will be very, very cheaper. But the danger is you won't be having the money to buy them at those lowest values. Businesses, some of them will close shops. Why? Because the demand of their wares has shrinked. Okay, so in that environment again, the profits will be very, very low. And as I've already indicated, businesses will close their doors, to close shop. Now, let's talk of another, elephant in the room. Inflation, the eroding power of money. What is inflation? This is a sustained increase in the general price level of goods and services. Sustained increase. This is too much of an increase. All right, over a longer period of time or on a constant pace. All right, there is no common agreed benchmark of what a sustained increase is, but in essence, we are looking at that continued increase in the general level of prices of goods and services. All right. An example is the Zimbabwean hyperinflation period. All right. Of the 2008 2009, where if you withdraw your money with the with the ability to buy a loaf of bread, let's say around 8 o'clock in the morning, when you return to the shops again around 3 p.m., you would find that the amount of money which you used to buy the same loaf of bread is no longer able to buy. You would need to increase that amount maybe twofold or threefold. That's the aspect of inflation, right? You would discover that if the loaf of bread was costing maybe 10 Zimbabwean dollars at around 3 p.m. the same day, you would find out that the loaf of bread would be costing 40 Zimbabwean dollars. All right, that's inflation. Of course, that was hyperinflation. Now, there are two different things. Inflation and hyperinflation are two different things, but I wanted you to get the definition correct. All right. Now, it might not be called inflation if the the increase of a price of a certain commodity has been triggered solely by other variables, peculiar to a certain company. All right, that's not inflation. We are looking at the general price increase of similar goods and services, right, in an economy. Right? So if generally prices have risen, generally it means on a wider scope or on a wider region or area, the prices have increased, then that's inflation. Are we together? So if prices have increased but incomes have remained at a standing still, then it means that what you were able to buy before the increase could not be the same after the increase. So the higher the inflation, the lower the purchasing power of an individual's income. All right. So there are impacts which are triggered by this inflation. On individuals, there is going to be reduced purchasing power, erosion of savings, increased cost of living. All right, erosion of savings. Here we are saying, suppose you have got your $100, which you put in a CBZ account or ZB, whatever bank you are using. Right. So today, this $100 was enough to buy you a bicycle. All right. If you could use your $100 today, you were able to buy a bicycle. But just because you have been a law-abiding citizen, you are storing your money in a bank, because of inflation, that is the general increase of prices of goods and services, then you are going to find out that if you withdraw your money after 1 month, the bicycle will be now costing 150. So it means that you have lost the value. Okay, so your savings have been eroded in terms of value. Why? Because they can no longer buy you as much as you could buy the day or maybe today. Are we together? What about on households? There is going to be reduced real income, difficulty saving for future expenses. So the total income the household was earning is going to be reduced in terms of buying power. All right. The businesses themselves, they're going to to discover or to face higher production costs. Why? Because by the end of the day, the service providers or even the suppliers themselves, they are going to have their goods charged above normal costs because of the inflation. Their prices will rise as well. So the businesses will find out that the cost of goods sold are going to be very high. This would also impact the profit margins. Why? Because the end consumer, his salary is not going to be increased because of inflation. His salary will be at a standing still. All right, the salary of people is normally not going to be increased in relation to inflation. That's the problem in a business economy, or I mean, in an ordinary or normal economy. Inflation usually goes beyond or rises beyond the pace of salaries. So by the end of the day, the end consumer, or the consumers, the general consumer, are not going to have their salaries increased. This is going to cause problems on their spending habits. Why? Because even if you you raise your prices, there is going to be a point when consumers are going to be, they're going to be ridiculed. They're going to be angered. They will be frustrated. They'll just adopt, a stance that says, okay, you've increased your prices, but we are not going to buy. Why? Because our salaries are frozen. Our salaries are not increasing in line with the inflation. So therefore, if we were going to buy 2 kgs of rice every 2 weeks, we are now going to buy 500 grams of rice every 2 weeks. Why? Because that's what their salaries are going to buy. So in the longer term, because the cost of goods sold is going to increase, but the selling prices are not going to rise as much. This would mean that the gross profit margin, or even the net profit margin, is going to shrink. Why? Because we are having, let us say, this was the selling price, this is the selling price, okay? And this was the gross profit margin. But because the costs have arisen, let's say to this level, all right, let me just say this was initially the cost of goods sold. So if we say selling price minus cost of goods sold, we normally have the gross profit. Okay? So initially on stage 1 day, that was the original cost of goods sold. However, because the costs have arisen, they are now at stage 2. You discover that originally the distance between all right, I think I cannot all right, let me just look for what's going on here. I want an eraser. Can I get one? Can I get one? Okay. I'm not getting the eraser. What's going on? I'm sorry. Just give me a minute. I don't know what's going on. Okay, maybe this is all right. Good. All right. Let's say at a point in time, let's say in month 1, all right, the selling price was 100, and the cost of sales or cost of goods sold was 80. Here, the gross profit was going to be $20, right? And this means that the gross profit margin The margin is the gross profit divided by the selling price. In this case, 20 over 100. So the margin was 20%. However, in month two, owing to inflation, all right, owing to inflation, the selling price, because the consumers, the end users of goods and services have got their salaries frozen at a particular point. They are only going to expect a loaf of bread to be sold at 100 zig. Okay, so it is going to be 100 zig. In Zimbabwe, we use the zigs. All right. Then the cost of producing the loaf of bread is now $90 because of inflation. It has risen from 80 zig to 90 zig. So this means that the gross profit is now 10 zig, and the margin becomes 10 over 100. That is 10%. So you can see that because of inflation, the businesses will be having lower profit margins. Now, there is also an aspect of potential price wars. This is now an issue that is becoming topical these days, all right? Where you will see that even if things are hard, even if there is inflation, some people are charging their loaves of bread at 90 cents per unit, whereas others are charging $1. That is a price war. Why? Some would say, I just want to use bread to call me customers. I don't want any profit. So it's now an issue of strategic attack. All right? But in essence, we call those things price wars, depending on your particular strategy. Some will be charging a certain price for their own reasons and so forth, just to ensure that they remain in business. Are we together? But all those are characteristics of a world where there is inflation. So inflation, my brothers and sisters, is impacts the way businesses operate. What about the impact of unemployment? What is unemployment? Of course, it means that one is not employed. Okay? All right, but in the macroeconomic sense, we are simply saying this is, the human cost of joblessness. All right? The human cost of joblessness. If you don't have a job, there are certain costs that you are going to, to face. All right? If there is unemployment. So unemployment is actually a situation where people who are able to work are not able to get the job. They're able to work, but what to work for is not available. All right? Or the opportunity to get the job is not there, but they're able to work. So there are normally three types of unemployment. Cyclical. This is demand deficient unemployment. We are simply saying that there is no demand for your services. All right. These could be, owing to seasons. Okay. In this particular season, they're not going to hire people, especially in the agricultural sector. There are periods when there is demand for labor in our sugarcane plantations. There are seasons when we do not want that labor. All right? That's cyclical unemployment. structural. This is when there is a mismatch between skills and jobs. Right? There is a mismatch between skills available and the jobs to be done. I'm sorry, electricity sometimes, cause these recordings problematic. Anyway, I did explain the cyclical unemployment, okay, where I said that owing to poor demand in the, of labor services, then we will find other people not being employed. All right. And I say that an equivalent of such a situation is when there is no demand of a particular labor just because the jobs are not available for such type of labor. All right, and I've put seasonal. However, I needed to correct that statement with some facts. All right, if this unemployment is short term, if short term, let me just say, if short term, it becomes what is called seasonal unemployment. All right, seasonal unemployment. All right, where maybe for a certain number of months, for example, 3 months, people are not going to be employed, then we call that one seasonal unemployment. All right, but if it is longer term, if it is long-term unemployment, that is, cyclical, where maybe because of certain trends, for example, we have been talking of economic cycles where the economy moves like this, right? Sometimes there's a boom, sometimes there is a recession. That's longer term unemployment fashion, where maybe for particular years, for particular number of years, people will be employed, and then after that period, they won't be employed. So that's cyclical unemployment. It's a bit longer term in nature. Right? So when we are in a recession, we are likely to face what is called cyclical. It's by nature of the performance of the economy as a whole, people are not going to be employed. All right. So it's demand deficient in the longer term. So that's cyclical unemployment. All right. That unemployment owing to the performance of the economy as a whole. Then there is what is called structural unemployment. This is the mismatch between skills and jobs. All right. This one again is a longer term unemployment. Okay. This is because, or maybe it arises because of there being some mismatch between the skills which are available and the jobs that can be offered. For example, if we are looking at an economy where maybe the people in general were surviving out of mining, okay, so they've got mining skills. However, the gold deposits or mineral deposits which were available have been, consumed up or have been exhausted. So in that case, because these guys have got mining skills, but the opportunity that is now available is farming, right? They don't have farming skills, but mining skills. So they are technically going to be unemployed because the skills which they have are not the ones which are being required. So that's a structural unemployment situation. It's a bit longer term. So if it involves if it involves technology, okay, technology, then it becomes technological unemployment. All right. For example, if the labor available has been manually oriented, but the job opportunities available require techno-savvy individuals, then the labor force available is going to be unemployed, and that unemployment is going to be called technological unemployment. Are we together? Okay, please get this and just try to replay the video and understand what I have been saying. I said cyclical unemployment is that unemployment caused by the booms and busts or the booms and recessions of the economy. If there is any recession, we are going to be experiencing unemployment. Why? Because generally the demand for more labor is going to be suppressed because we are in a recession. The economy is performing poorly, and by nature, that's a longer term type of unemployment. Cyclical is a bit longer term. All right. But if it is short term, if that performance of an economy is short term, it becomes seasonal unemployment. All right. It's a bit short term, maybe because of seasons. We are in a dry season and very few labor is required. Therefore, we don't want, people are going to be unemployed. But during the harvest time or the plantation and so forth, when there is active agricultural activities, then more people are going to be hired. All right. So that's what we mean by seasonal unemployment. That's a period when the labor, because of the season, they are not going to be employed. Then structural, we are talking of a mismatch between skills and jobs. Right? The available skills are not going to, to enable individuals to be employed because the job opportunities available require a certain type of skill different from the general population in that particular area. All right. But if the skills required are linked to technology, it becomes technological unemployment. Are we together? Do not pick structural unemployment in that case, because if it involves technology, it becomes technological unemployment. The people, they do not have the technological skills required. So there is a mismatch. They know they want to work, yes, but their skills are not matching the job requirement technologically. So it becomes technological unemployment. What about frictional? Frictional is temporal unemployment between jobs. Usually, in this case, the potential employees won't be having the knowledge that a particular job market is open. Okay, they don't have. It's usually temporal. People are not yet aware that in a particular region, their skills are required. So it's an issue that is caused by short-term labor market information asymmetry. All right. No information is readily available such that the labor units can be linked to the jobs available. All right. That's it, ladies and gentlemen. So what are the impacts of unemployment on individuals? There is going to be loss of income, reduced living standards. Yes, if you are not working, obviously the living standards are going to suffer. They're going to tumble. Social and psychological problems. People will be stressed. There is depression. There is, all those, and people sometimes they end up abusing drugs because they are not being employed. Households, financial hardships, increased stress, potential family breakdown, where wives are going to abscond their husband, they're going to, the marriages will collapse and so forth. Then the businesses, there's going to be reduced consumer demand, social unrest, potential labor shortages in the future. Impact of economic growth. There are certain aspects I thought maybe I should explain linked to inflation, although they might not be required or they are not being required in this particular syllabus. The examiner might get an extra, might become too pedantic and try to link them. All right, so there is need for us to just cover the types of inflation that are available, so that by the end of the day we are safe. All right, we need to be safe. Okay, so normally these are causes, not types of inflation, but causes of inflation. We need to know them. Okay, we need to know them. All right, the first one is what is called demand pull inflation. All right, the second one is cost push inflation. Then there is what is called imported inflation. All right, and we also have what is called monetary inflation. Lastly, we have what is called the expectations effect. Expectations effect. Let's start with demand pull inflation. Demand pull inflation arises when more people are chasing fewer goods. All right, there are very few goods in the economy, but there are more buyers. So if there are more buyers, because they are competing to get those few items, the sellers are motivated to increase prices. All right, let us present this diagrammatically. Can I get, let me try to get an eraser. Good. All right, suppose this is our graph. Let us draw a graph. Okay, these are the general prices. And this is the national income. All right, just for illustration purposes. All right, and normally the supply curve. Okay, all right, let us first draw the demand curve. Let us say this is our demand curve. This is demand curve 1. All right, and these are the times. All right, let's say this one is year 1. This one is year 2. Something like that. All right. Now we are at price P1. Okay. In year 1, we are at price P1. Let's say people in year 2 have determined what shall I say? Okay, in year 2, their demand for a particular commodity has increased. So let us say the supply of a commodity, the supply curve was this one. All right, initially, that is in year one, right? That was supply one. However, in year two, the demand of the commodity, right? The demand of the commodity um, has increased, right? Has increased. We now have got this was D1 and this is now D2. Okay, you can see initially that at the start, okay, the price, let us say our P1 was at this point, okay, where the demand and supply meet. However, because the demand has increased, we can see that the price P2 this one should be our P2, okay, this should be our P2. The P2 has increased from P1. You can see that we have increased. Why? Because the demand has increased. Therefore, the prices are rising from P1 to P2. Okay. Now, if if demand had increased, had decreased, you would see that the demand curve will fall from D1 to D2. Here, because the demand had increased, it had decreased from D1 to D2. Now it has fallen from D1 to say D3. All right. So usually prices are motivated by demand itself. If more consumers are going for very few goods or for the fewer goods, then suppliers of those goods are motivated to increase prices. That's demand pull inflation. So what do governments do in those contexts? Usually the governments are going to attack the demand side. What they will do, they will increase taxation. For example, they will increase taxation or cut on government spending. If they increase inflation, taxation, people are going to be, to have low disposable incomes, and by so doing, they will force the suppliers to decrease their prices as well. So in the end, because there are fewer consumers to buy, then the prices will go down. All right? This sometimes happens. All right, that's demand pull inflation for us. What about the other inflation type? Cause. There is what is called cost push inflation. Cost push inflation is when the cost of producing a good, right, is going to be higher just because of the production costs involved. So in that context, because the cost of producing are high, therefore the final product or the final price of the product is also going to be higher. All right. So it is linked to production methods that are being employed by organizations. Okay, so one thing I want you to appreciate is that the cost push inflation is not motivated by demand or supply. All right, it is just motivated by the production means. This is why governments are encouraging the adoption of technologies. They want individual businesses to lower their production costs through the adoption of technology, of efficient energy use or efficient energy methods like green methods, green fuel, all those things, to ensure that by the end of the day, the cost of production goes down. All right. So energy efficiency is also one of the aspects governments are advocating for. All right. This would, in the longer term, reduce the cost of production in an economy. The adoption of technology, the adoption of energy efficient methods, all those, they help the economy to reduce the cost of production. What about imported inflation? Imported inflation is that inflation that is caused by goods which are imported. All right. Okay. Or that is linked to imported goods. For example, a rise in the price of oil. Price of oil. All right. This one has nothing to do with the demand. Even the demand is high, the price of oil is going to be high. Even the demand is low, the price of oil is going to be high. All right. So that type of inflation is difficult to control. All right. Then there is monetary inflation. Monetary inflation is linked to the supply of money. If there is too much money that is supplied in an economy, people will be having a lot of money, but by the end of the day, it will buy nothing. Why? Because the suppliers of goods are going to increase their prices, motivated by the fact that people have got a lot of cash in their pockets. Are we together? So printing a lot of money is not going to be a solution. There is going to be what is called monetary inflation. Lastly, there is the expectations effect. Expectations effect is people are going to always think that inflation is going to arise just because they've just noticed a small instance of inflation. All right. So, for example, maybe in Zimbabwe, when people see a certain rise in a price, let's say of a loaf of bread, they just think that, oh, so tomorrow everything will be having prices ballooning, or maybe the general prices are going to increase by the end of the week. So people start to do whatever things they would do, for example, hoarding commodities and so forth from the shelves of those supermarkets, just to, out of fear that tomorrow there's going to be, too much inflation. Right, so that's the expectations effect. So I wanted to just highlight these issues so that when we proceed, nobody's going to be left behind. All right. Did we say something about this? All right. Impact of economic growth, a rising tide lifts all boats. That's the general idea. If there is an economic boom, therefore everyone is going to enjoy. That's the idea. All right. So individuals are going to have high incomes, increased job opportunities, and so forth. Households are going to have increased wealth, greater access to goods and services, improved quality of life. Businesses expand their markets, increased investment opportunities, higher profits. All right. Impact of international payments disequilibrium. Remember, we talked of the sustained or sustainable balance of payment state in an economy. All right, so we are still expanding the concept here. So the global interconnectedness of economies. Current account deficit. This is when imports exceed exports, right? Leading to a loss of foreign exchange. We say that the net exports, remember when we talked of net export, this is a position when the exports exceeds imports. All right, but this is now the vice versa, the contrary. Current account deficit is when imports exceed exports. All right, current account surplus, this is when export exceeds import, leading to an accumulation of foreign exchange. So current account surplus is actually the net export position. So what is the impact of this disequilibrium? Individuals, there is potential for currency devaluation, impact on import prices. All right, households, there's going to be increased cost of imported goods, potential for job losses in import competing industries. All right, so because there is, a disequilibrium where the foreign currency reserves are going to be in short supply or are going to be in lower levels, then ordinarily it means that if our industry is sustained through imports, for example, if we are, if we rely on imported cement, for example, if we rely on imported cement, but we do not have enough foreign currency reserves, what it means is that we are going to find it difficult to import cement. And those businesses who have got employees in them, they're going to retrench some of the employees. Why? Because they can't operate at maximum capacity because there are no foreign currency reserves to procure raw materials, to procure goods for resale. This is actually common in many industries in Zimbabwe, where we see them closing shop. Why? Because there is a deficit in the current account. There is a deficit in the sense that the foreign currency reserves are so low. So if we do not have the foreign currency reserves, adequate foreign currency reserves, it means the imports are going to be very expensive and our companies are not going to be very competitive. So this is why you see on the businesses impact, the competitiveness challenge is going to arise. Our businesses are not going to be able to compete with other businesses of similar sizes. Why? Because it is very, very difficult to import raw materials. Why? Because access to foreign currency reserves is restricted. Are we together, ladies and gentlemen? Good. Now, let's talk of economic policies. And we say that an economic policy is just a government intervention in the economy. We have got what is called a fiscal policy, a monetary policy, all right, and some what are called supply side policies, all right. But the most common ones are the fiscal policy and monetary policy. What is a fiscal policy? This one is, this one talks of government spending and taxation. All right. An example is increasing government spending to stimulate demand. The government might chip in, for example, in building a road that links two major cities, or rehabilitating a hospital to ensure that the population or the people in a particular community are healthy. This will build, will boost productivity and encourage investments in that area. All right. So that's fiscal policy. The government could also reduce taxation to boost consumer spending. If, for example, people were being charged pay as you earn on their salaries of say 30% and are now being charged 15%, it means the other 15% has been retained, has been, kept safe on their salary. It's not going to be deducted. So they will be having a lot of money. So by so doing, they are encouraging consumer spending. People now have got more cash at their disposal to enjoy. Okay, so that in the end will boost the business activity, the business environment. Then, if we talk of monetary policy, this is a policy linked to central banks aimed to control the supply of money and the movement of interest rates. Okay, so it controls money supply as well as interest rates. Examples: lowering interest rates to encourage borrowing and spending. So if the interest rates are low, it means that it is now cheaper to borrow money, and a lot of people will be going for those loans and having a lot of money at their disposal. Then consumption assumes or resumes. Right? Then, in increasing interest rates to curb inflation, sometimes the government will increase interest rates if they find out that, oh, people now have got a lot of money, but now there is now inflation. Okay, inflation is now there. We have been talking of demand pull inflation or the monetary inflation. If those are now a nemesis, then the government will increase interest rates to curb inflation. Now, the demand side policies. These are policies aimed at improving efficiency and competitiveness of the economy. Examples: investment in education and training. Sometimes the government would come up with policies aimed at promoting investment in education and training. Deregulation of markets such that barriers to entry are limited or are reduced. Right? Then tax incentives for businesses. Right? So you discover that these ones are not really policies per se. They actually fit into either of these. All right, good. Impact of fiscal policy, government spending and taxation. All right, so if we're looking at a fiscal policy, we are going to ask ourselves, is this policy expansionary or contractionary? An expansionary fiscal policy aims to increase government spending and reduce taxation. The impact: this can stimulate economic growth but may lead to higher government debt. So we just have to let our finance ministers to be aware that in as much as the government is entering into such development projects to ensure that we live luxuriously by into an upper middle income economy by 2030, we also have to be aware that this could lead us into higher debt. We don't want to be having our public debt ballooning. Okay. Then on the other hand, we have got what is called contractional fiscal policy. This is a stingy association type of policy, right? A stingy association type of policy, all right? In this case, the government would reduce its spending and at the same time increase taxes, right? By decreasing taxes, it means that they would want the fiscals to have a lot of money such that in the future they will be able to offer services again. All right. Impact. This can help to control inflation but may slow economic growth. So those are the impacts this policy could bring. What about the impact of monetary policy? All right, here we are looking at the control of interest rates, okay, the control of interest rates and money supply. That's the aim of the monetary policy. All right, so lower interest rates. If the interest rates are low or are lower, this will boost consumer spending and encourage borrowing. It can stimulate economic growth but may fuel inflation. Why? Because there's a lot of money and inflation could be fueled, or because the people have got a lot of money chasing fewer goods. By the end of the day, that would as well trigger inflation. Then higher interest rates, these ones discourage borrowing and spending, can help to control inflation but may slow economic growth. In conclusion, let's summarize the main points of the lesson. Macroeconomic factors have a significant impact on individuals, households, and businesses. Governments use various policy tools to manage the economy. All right? Understanding macroeconomic concepts is crucial for making informed economic decisions. All right? So those tools are those policies we have been talking about, because we say that a policy or a macroeconomic policy is an intervention or a tool to intervene which can be used by the government. Now, practice questions. Question 1. What is the primary objective of macroeconomic policy? A. To increase business profits. B. To reduce international trade. C. To achieve economic growth, price stability, and full employment. D. To maximize government revenue. What is the primary objective of macroeconomic policy? Please pause the video and attempt on your own. Good. I'm very happy you have determined the correct answer. This is C. To achieve economic growth, price stability, and full employment. But remember, I said that usually this objective is normally not attainable. So usually they normally say low unemployment instead. Now, which of the following is not a determinant of business activity? A. Consumer spending. B. Government spending. C. Inflation. D. Net exports. In our analysis, this one is an odd one out. Please revisit that part of the video. The rest are the determinants, but inflation is not. If you think otherwise, please make a comment, write down this video in the description box. What is the most likely impact of high unemployment on households? A. Increased disposable income. We are talking of the most likely impact of high unemployment on households. If there is high unemployment, obviously things would be bad. A. Increased disposable income. Could that be a result? Obviously, this one is out. No. Lower living costs. Will the costs be lower because people are unemployed? Obviously, this one is out. C. Reduced purchasing power and savings. Let me leave that one for now. D. Higher investment in businesses. If the people in a particular area are unemployed, the majority are unemployed, would you open a shop in that area? Obviously not. So this one is out. And by so doing, the answer is C. 4. How does fiscal policy primarily influence the economy? A. By regulating the money supply and interest rates. Is this not the monetary policy? Yes, it is. So therefore, it's the wrong answer. We are talking of the fiscal policy. B. By adjusting taxation and government spending. Yes, somehow linked, but let me just ignore it for now, just to err on the side of caution. C. By imposing tariffs on imports and exports. Yeah, we know, yes, tariffs are part of some, taxation, but are those the primary, the primary impacts or influences of fiscal policy? Because the question is saying, how does fiscal policy primarily influence the economy? So, can we influence the economy by imposing tariffs on imports? Primarily. D. By encouraging technological innovation through fiscal policy. So you can see that the competing answers are B and C. However, we are constrained by the word primarily. So therefore, the answer should be B. By adjusting taxation and government spending. That's what we have learned in this lesson. The last question. What is a key characteristic of monetary policy? A. It is managed by the government through taxation. Is this monetary? Because we're looking at monetary policy, and this one seems to be fiscal policy. It focuses on reducing international trade deficits. Monetary policy, okay. B, it focuses on reducing international trade deficits. That's not the key characteristic of monetary policy. All right. So that one, anyway, I'll explain it. All right, but that's not the answer. It is controlled by central banks and focuses on interest rates and money supply. That's the answer. D, it aims to increase government spending to boost economic growth. Government spending, this is fiscal policy. So fiscal. So what is this one? Okay, now these ones are called protectionist policies. Remember we said that a trade deficit is a situation where we are having a current account deficit, or we are in a negative a negative net export position. All right, our imports are larger. Our imports will be larger than the exports. All right, that's a trade deficit. We are relying more on imports and than on exports. So what it means is that we'll be losing more of foreign currency through the import. Again, we'll be making our local industries suffering. Okay, why? Because we are not relying on goods which we produce. So our firms, our local firms, the National Foods, the Agri-Foods, the Delta Beverages, and so many, all our companies, our Zimbabwean companies, are going to suffer. The Simba brands, the Econet, they are going to suffer. Why? Because we are relying on on imported services or goods from China, from the USA, and so forth. So that will cripple the domestic industry. So the government will come up with the policies that will address those things. And these policies are what are called protectionist policies. They are aimed at protecting the local industry. Please get this right. Are we together, ladies and gentlemen? I hope this video has been useful to you. If it was indeed, or if it is indeed helpful, please subscribe to this channel, like the video, share it with your friends so that they also know that there is what is called Transcal Business School, a Zimbabwean online business school aimed at coaching you throughout your ACCA journey. Until next time, please continue to feel excited. I mean, very, very excited. Thank you. I am the ACCA tutor. I am signing out. Bye.